Tomlee is back with us for his latest musings on the markets. It's managing partner, head of research at Fundstrat Global Advisors, as well as a CNBC contributor. People forget, I think, but your outlook and views are always nuanced to some extent, Tom. So last time you were on, after being pretty bullish on small caps through the end of the year, I wouldn't say you didn't change that long-term view, but you did express some near-term caution. And these people want to know, the people that follow you, the people that watch Squawk Box, they want to know exactly what to do every minute of every day. So it looked to them like you had waffled on your long-term view. And you're going to say the same thing today. I think near-term, you acknowledge that there could be some bumpiness, choppiness, but by the end of the year, you think 6,000 on the S&P.
That's right. I think we're still in the midst of a very tricky period because we've got the election in less than 35 days. And now we've got two things that investors don't know how to discount. One is, mounting tensions in the Middle East, and then a port strike that is potentially going to cripple the economy. And so I think that as investors worry about this, if we get a dip, and a big dip, I think you still want to buy that dip because the setup into year end has a lot of tailwinds.
The worst case scenario for the port situation is something that we've seen. And we shut down an economy already, and that was probably a time to buy. We know that. So we've seen that movie before. Could it be? I can't imagine it could be as bad as the pandemic, but we have shut down an economy before.
Yeah, that's right. So I think it creates headline risk because, the longer this strike lasts, there'll be companies that miss, and so S&P earnings might get downgraded or some stocks might miss results. But that's all just temporary. I mean, those are just short-term headwinds because it doesn't change the long-term outlook.
It's very strange that I don't remember any war that lasts, that where the effects, and we've been through quite a few back in the 90s and in the 2000s. It never seemed to have as negative an effect on the overall markets as we thought at the beginning of each.
That's right. In fact, if we look at the last 6 sort of global wars or tensions, you almost always buy the invasion. The exception was 2022 with the Russia-Ukraine war because we were also in the midst of a Fed tightening cycle. So that was not a buy the invasion event. But the other times you did want to buy.
Both Iraq wars.
Yep, both Iraq and.
Was the market, where was the market before that happened? Had levels come down, or were they trading at near highs or at highs?
Yes, this is different because we are hovering near highs and we're in an extended market.
And things aren't cheap in terms of multiples.
That's right. But at the same time, we also know there is a lot of cash on the sidelines.
Right.
Because margin debt hasn't risen for 4 months. I mean, that's pretty unusual with a rising stock market. And now money market cash has actually been rising at a time when the Fed is cutting. So I do think there's firepower.
The other issue, just the longshoreman strike, if that goes on for an extended period of time, is that something? We were talking before how much that cuts off the GDP. If it's there for a week, maybe cuts 0.3 of the GDP.
Yeah.
For every week they're out. Is that something that the Fed comes in with much more aggressive cuts and that fixes things, or are there inflationary factors that also come into play and that ties their hands?
I mean, the Fed has to kind of put that in their calculus because the labor market has also softened. So if this is a shock in a way that causes the labor market to weaken, the Fed's going to be a lot more dovish. But we get the payrolls report Friday, and I'd say maybe it sort of early hints seem like it's actually going to be a better than expected report.
But then you also add in what would happen from inflationary pressures, not only from the longshoreman strike, but potentially from oil prices going up in the Middle East, too.
Yeah, that's right. I think the Fed at this point would be more concerned if the consumer expectations got unanchored on inflation, and those have actually been improving. So I think the Fed can be less worried about the inflation side of it.
Did you see Tepper talking about China? Would you ever
subscribe to that theory?
Buy a lot in China?
Yeah, I mean, I'd say that not only did China launch a bazooka, but it's really working, right? Because the stock market has really broken out. I think China is now the best performing stock market this year.
But was the move made? I mean, I think, we had Kyle Bass on yesterday, and I think he would argue long term, no matter how you want to think about China, it's a bad bet. he was suggesting maybe in the short term, it's a good bet. And I don't think he was necessarily opining on whether the bet is over. But the move, obviously, the big move has happened. The question is, do you see that doubling? Is that in the cards at this point of the game?
Yeah, I mean, something to keep in people's back of their mind. Over the last 10 years, China has underperformed the U.S. by 7,700 basis points. So if China doubles, it's still underperformed by like 5,000 basis points. So, I mean, there's a lot of room for a rally, even if it looks corrective.
I think his phrase was something like, it's just a bad bet on communists.
No, he's saying long term it's a bad bet, but he's saying short term it might be a good bet.
It's not our grandfather's communism. It's almost, I don't even know we need a portmanteau for what capitalism, based with communism is.
Yeah.
Kidding, Andrew. Kidding.